In this session, we will look at some important linkages between the corporate governance and the risk management. Because one simple way to really look at corporate governance is the existence of the practices of the company or the way the company performs its business, having a board and some senior management committees and all, with an intention to protect the interest of the shareholders. That's a major part of corporate governance. The processes, the policies which the company has set in place in such a way that every action the company takes is in the interest of the shareholders. But on one side, the shareholders typically want the share price to keep going up and up and up. Whereas the risk management, though it is contributing to the increase in the value of the firm, it is something associated more and more with the calculated risk taking. So, how do these two things go together? What is it that is really required to ensure that there is a good coordination between these two aspects is what we'll look at. And today, the reason why these two need to be integrated or these two need to be looked together is in a lot of high profile corporate scandals, we see that the risk management practices as well as the corporate governance practices, both of them are really being completely misused. So when you look at majority of the financial scandals that have occurred, either the misleading information has happened to the board, right? Correct information not given in the case of bearings, a single trader, the profit positions, the profit of the various positions has not been communicated to the senior management correctly. So the board is provided with misleading information. Whatever the kind of mechanisms, the information, the technology that is typically being used to communicate the information to the board, even that is a faulty system, which is again an operational risk kind of an area. Majority of the financial scandals that came out, they involved financially engineered products which are very complex, and the board could not have sufficient knowledge to understand and appreciate the positives as well as the negatives of those products. So majority of the times we see complex engineered products created, and the economic risks that are behind it, only the positives have been promoted by the financial engineers to the top management, ignoring the negatives and the risks that are inbuilt into those kind of products. And because of all these reasons, obviously, there is a pressure on the board as well as the management to implement the risk management practices effectively. With so much of innovations happening in the world of finance, it is becoming utmost necessary that the board and the senior management have a good understanding of the world of risk management, of the world of finance to a large extent. There is an immense pressure that is getting built on the regulatory and the rating agencies, because one of the reasons for the 2007 failure has been the rating agencies which did not take enough, which did not have enough knowledge in terms of how to rate the asset-backed securities or the collateralized debt obligations, which were the new financially engineered instrument that came at that point in time. The inattention and the incompetence earlier, they were simply ignored, but now they are getting equally punished, which means now the board cannot escape saying that this is completely unaware to us. We don't have the knowledge in this particular process. Only this particular trader or employee has done this entire process. Board cannot escape, because now with the SOX compliance coming up, it is the responsibility of the CEO and the CFO to typically sign on the financial undertake that they are responsible for the numbers that are shown in the financial statement, which means it is becoming a necessity today to understand finance even for the non-financial person. The inattention and incompetence today are punished as a deliberate act only. And for majority of the organizations, the outcome of this entire scandals is the risk analytics department came up, which is primarily responsible for evaluating, coming up with the models on different kinds of risk, identifying identifying the historical data, doing some kind of calculations and evaluations on the historical data, come out with models and frameworks which can really help an organization to go on proactive mode with respect to the risk management. And when I try to integrate these two worlds, just if we look at it on a broader sense, the board of directors whose main intention is to work on behalf of the interest of the shareholders, along with that they should be really sensitive to the other stakeholders like debt holders as well. And on an overall scale, their main job is in terms of overseeing the management and holding it accountable whenever they are deviating from the interests of the shareholders. That is the major objective of the board. Along with that, obviously they do because of the expertise they do carry, they contribute to the development of the overall strategic plan of the firm. Now, as a part of the strategic plan, the core component from the risk management framework is the risk appetite. To what extent the company is capable of taking on the risk, and set the risk tolerance limits for every business unit, for every department. And be alert on the agency risk. Whenever we talk about the agency risk, it's a kind of conflict of interest that arises between the management and the shareholders and the different stakeholders. What is this conflict of interest? The management can implement its own policies, its own processes, which can really benefit them rather than the stakeholders. But the board is majorly responsible to make sure that the company is implementing those activities which majorly benefit the stakeholders, not the management. So that is where these two things should come into picture. What the management is implementing should be in line with the stakeholders. That is what a corporate governance says. Even the risk management strategies that the company is implementing, they should be in line with the shareholders' expectations only. And today we see that one of the important roles that is getting created in the organizations, which actually start some kind of interactions with the board as well as senior management, is the role of the CRO, the Chief Risk Officer, whose major task is in terms of integrating the corporate governance responsibilities, the responsibilities of the corporate governance with the risk management departments, the market risk, credit risk, operations risk, business risk. So into every risk department's responsibility, try bringing and integrating the corporate governance responsibilities. So basically you have a market risk department, credit risk department, operations risk department, and a few corporate governance practices. These corporate governance practices should be bundled into each of these risks. That is where the integration between these two worlds comes up, and that is what is the role of the CRO. So there needs to be a clear understanding of the overall business strategy, the risk and reward it carries, and it has to be transparent to all the stakeholders. To what extent the company is willing to take the risk, to what extent it is willing to transfer the risk. So the entire risk policy of the firm, what is the kind of return that is expecting, because some stakeholders may be of the opinion the company would generate 20% return on an annual basis, because it has generated a couple of times earlier. But now the risk management processes are so tight that yes, on a consistent basis, the company may generate around 10 to 15% profit, but may not be 20% because that is subjected to more and more risk. The business and the risk management strategies which the company is following, they need to really look at not the accounting performance but the economic, because why we are talking about it is whenever my target is about accounting performance, it could be resulting in short term kind of result. The profits can either go up in the short term or can be manipulated for the next financial year, and after that probably for one before one more year the person would have picked up his bonuses, and after that the next year there could be a collapse. So any strategy that the company is implementing, it needs to be looked at from the economic benefit. Economic benefit is more like a long term benefit rather than the accounting performance of the firm. So from that perspective, proper procedures should be in place, right from identifying the risk, evaluating, assessing the risk, and coming out with the various management aspects for different types of risk: credit risk, market risk, operations risk, all kinds. So there should be clearly defined policies in place, processes and methodologies in place, infrastructure, the technology, all these things, the software, the program, the data, the personal people with the relevant skills, all these things should be there to integrate these two worlds of corporate governance as well as risk management. Right? Now, what are the various choices that are available in risk management? We all know it. Either I can avoid a risk, means I will not take up some projects and some activities at all, or the company can transfer that particular portion of risk to third parties using either insurance or any hedging activity or doing some kind of outsourcing, which is where the financial recovery can very well happen. Financial reimbursement of the losses can occur through any of these processes, or internally they can get into a mitigation of the risk, coming up with some kind of a preventive and control kind of mechanisms, or say I'm going to accept the risk because this is something that is strategic in nature. I am going to take it up because I am believing that this additional risk that I'm going to take up is going to increase the shareholders' value. Now, from the board's perspective, whatever the decisions the company's management has taken regarding the risk management, different kinds of risk, it has to really evaluate whether each of these things are really in line with the interests of the shareholders or not, or to what extent they are going to fire up on the shareholders. Now, this is where, if at all, as an external analyst, I want to see whether the company is really serious about risk management, or it just making a few statements relating to the risk management to create a buzz. If I want to see that, a few checkpoints for me. Look at the career path they have offered in the risk management function. Do they have the career path right up to the role of CRO from the initial executive levels? Risk manager, senior risk manager, heading a specific department. So, is there a path laid out for the risk management function? What are the kind of reportings that are there for the risk manager? Is he directly reporting to the business unit head, or is he reporting more to a CRO kind of a role, which is a functional head? What is the kind of reporting that is present? What are the kind of salaries that are being paid to the risk managers versus the line managers? Are they really same, or these guys being distinguished in terms of lower salaries? So if the salaries paid to the risk managers are much lesser compared to what are being paid for the revenue based managers, then probably the company is taking risk management as a control function, not a development function. What are the what is the kind of ethical culture the company is having, not in the newspaper, not in the papers, but in reality? What kind of checks and balances the company is really implementing? What is the way in which the staff are rewarded, and what is the compensation policy? Is it more targeted towards generating the profits and net income and the share price, or is it more directed towards the risk adjusted performance? The more and more it is directed towards the risk adjusted performance, probably I can very well assess that the company is really serious. And whatever the compensation mechanisms, if they are more and more aligned with that of the interests of the shareholders, then it means that even the processes are following good corporate governance practices as well. Are there any instances where in some form or the other, in some to some extent or the other, the company has got into the manipulation of the financial statement so that the value of the firm and the share price are going to boost up in the short term? That's going to impact the corporate governance, very poor corporate governance practice. So, and at the same time, the risk management practices are also much not that serious in that particular firm. Any kind of major transactions the company has done, any financial transactions with the suppliers, with any other entities, are they really consistent with whatever the risk that has been authorized and documented as a part of the risk policy? And are they in line with the strategies that have been identified, or are they clearly deviating from those strategies? So every transaction which is a major transaction really need to be checked out for its compliance with the risk policies. Is it really happening in the organization? And what is the kind of accuracy, a risk management information data that you have collected from various departments? What is the kind of consistency that is present in that data? What is the kind of accuracy and reliability that you can associate to it? Because just as a dump of the data anyone can provide, is it really consistent across the departments? Is it really making sense when you have looked at the data in terms of being usable for doing some kind of calculations and coming up with some kind of limits? How accurate is that particular information that you are receiving? And what are the various mechanisms that are used within the firm in order to delegate the proper functioning of the risk management decisions? All these things are typically going to add up to the confidence levels that the company is really serious about the risk management. And the other way you can look at is the various committees that are being set up, because the intention of any committee is something that is really committed towards that particular task. So the intention of any committee is to translate the goals, whatever have been set, into the reality, into the implementation part. So we really can assess the seriousness by looking at the committees that have been set up, because generally in a banking industry we see the risk management practices by now are more and more advanced because of various failures that have come out in the recent past as a part of the 2007 debacle, and at the same time because of the kind of leverage the banking sector works on, because of the kind of cash turnover the banking sector typically relies on. there is a lot of need for advanced risk management practices in the banking industry. Even the same kind of procedures can very well be adapted to other industries as well. Probably the names and the roles and the responsibilities could typically change depending on the nature of the business. But what we see is every firm may have a senior risk committee, which is a part of the board, which is responsible for the overall oversight, and there could be junior risk committees at the business units level, which are typically trying to handle specific units, specific types of risk. Probably there could be a separate risk committee for market risk, separate for business risk, separately for credit risk, and there could be a separate for each geography. So there could be a junior risk committees addressed toward each business unit level or specific risk type, whereas there could be a senior risk committee which is taking charge of the overall oversight of the risk management function of the particular organization. And also we would be looking at the audit and the risk management committees, how effective they are, because the audit committee is having a responsibility in terms of making sure that the company is preparing the financial statement in accordance with the financial standards. So along with that, it is also entrusted the responsibility of checking the compatibility of the firm's risk management strategy as well. So the main intention of these committees is to go and ratify the key policies and procedures that have been created by the board and the senior management towards the risk management, go towards the implementation of them, and probably whatever the risk appetite that has been set at the organization level, risk tolerance limits that have been set up for each business unit, they're actually translated to the workable limits to each business unit. So a clear cut defined limits at a micro level are being created and being passed on. And of course, we need to make sure that the balance need to be struck between ensuring a business that can meet the business goals as well as the maintenance of the overall risk standards. That's the role of the different committees within the organization to make sure that the risk management policies, practices are appropriate and they are implemented fully to see the desired result. And whenever we are looking at different types of mechanisms of the risk governance that could be there, broadly we could see two types. One is a traditional, where there is an audit committee, and audit committee is given a good set of responsibilities, because that becomes the most critical committee with respect to the risk governance. That's a traditional form. In every company, there is an audit committee which is responsible for making sure that the firm is complying with the best practice standards. Whatever their main responsibility, though, lies with financial and regulatory reporting kind of standards. Is the company sticking to making its financial standards in accordance with GAAP or IFRS kind of standard? Apart from that, they are also entrusted with the responsibility to make sure that even from the risk management perspective, the company is complying with the best practice standards that have been set up. So all the members of the audit committee need to have a good amount of understanding on the financial and risk management terminologies. But the main important part of any audit is to really ensure whether the firm is doing what it is saying. Because majority of the times what we see is what the companies say will be much more than what they really do, right? When it comes to saying, they talk about all kinds of attractive stuff, all kinds of best practice stuff, but when it really comes to the implementation, you find even a couple of percentage of what has been said may not be translated into the action. So that is where the audit committee comes in terms of ensuring that company is doing what it is saying. And the committee is typically containing the right mix of knowledge on risk management, has a good amount of experience who can really judge what is right, what is wrong. They need to have that kind of independence, not involved with, not colluding with the senior management of the firm. They need to maintain integrity, commitment towards the risk management. And generally, what we see is the audit committee is led by a non executive director. And along with that, we see that the reporting, risk management elements, all these things are clearly set aside. That is the traditional form of risk governance. Here, we don't have anyone specific in the risk. We don't have the roles of CROs or specific risk committees. Those kind of things do not exist. It is the typical audit committee which is taking care of the entire risk management process. But when it comes to the newer mechanism, it is very clearly understood that not all board members can have the requisite skills. So they really need to get the independent support from the external who can really interpret the risk and risk process information. So they need a specialist. So this is where the role of risk advisory director came into picture. Bring one person with real specialization in the risk matters, get into the board. That improves the overall efficiency and effectiveness of the decision makings by the board. And that is where we see there is an ongoing examination that will happen between the corporate governance and the risk management in terms of policies, methodologies, infrastructure. This role becomes very crucial in the board. And that's where, if I look at the key roles, this particular person, whosoever comes onto the board, he is participating in the audit committee meetings. So is acting more like a representative of the board, who is having the risk skills. So he is always interacting with the audit committee. So he is participating in the key risk committee meetings, provide independent commentary on the executive risk reporting, because he is the one who is a part of the board. So key members of the management he meets regularly. He is on a regular basis. He is observing how the business is conducted, the best practice, corporate governance and risk management practices that are there, their policies, methodologies, infrastructure, all those things are really provided. And from an education perspective, he brings a completely high level in terms of the risk profiles and the various risks that are associated with the business. So there is a complete change of environment that comes into the firm with this risk advisory director. And typically, when I look at what are the kind of knowledge or what are the different things, he need to have a good understanding of the risk management policies, methodologies, infrastructure. He need to really understand what goes as a part of the daily, weekly risk management reports. Probably, if required, he may have to design what needs to be captured as a part of these reports. The overall business portfolio, get a complete understanding of what are the various risks the company is typically having on a broader scale, and what are the different actions which it is following to drive those risks, what are the business strategies the company is taking, and how they are going to either increase or mitigate the risk of the firm. How strong are the internal controls and what are the various internal controls the company has to typically address the different kinds of risks. Financial statements, you need to understand and evaluate the financial statements, a good understanding of the critical accounting principles, and what are the estimates and the judgment the management has really prepared in terms of made in terms of preparing the financial statements, what are the various estimates that are there, and any kind of off balance sheet financings the company has done. In short, a good understanding of the financial statements and the components that go into the financial statements, and he should have that amount of knowledge where he can evaluate the financial statements critically, and any kind of disclosures the company has provided as a part of the financial statements, a very good understanding on audit reports, a very good clarity on both internal and external audit reports and the management letters which are associated with them, any affiliates the company is having, what is the kind of interaction and transactions that typically happen between the company and its affiliates, any related party transactions. In short, this entire thing is focusing on the information from the financial statements, trying to compare them with the reality, and just try to have an external perspective of how the competitors, what are the practices they are following on the risk management, what are the industry trends with respect to risk management. All these things are really required by the risk advisory director so that he can really work out on an implementation plan for the same. And when it comes to the risk management committee, this is a committee which is working, whose main role, which is working under the guidance of the risk advisory director, where the key role comes in terms of independently reviewing the identification, measurement, monitoring, and controlling of the risks. And if at all any kind of deviations are there, they are referred to the audit committee, and audit committee is going to relook into those kind of stuff. And individual credits that are there above a certain limit, they are going to approve, and and on a regular basis reviewing whether the individual credits are within those limits or not. The kind of credit that is being offered to individuals or institution, make sure that it has not crossed a particular limit. On a regular basis, this committee is going to report to the board all the loans which are exceeding a special limit. Probably they have some special kind of loans, or probably some kind of loans which are being shared with the internal employees. Some loans given to the internal employees, the rates at which they have been offered, all that kind of details are being provided to the board, and it monitors the credit on regular basis, securities, the portfolio of the securities, overall composition, and industry wise breakdown. That's one more task. Separate direct and private communication with the chief auditor, external auditors, management committee. So there is a senior risk committee which is on behalf of the board. It determines what should be the amount of the financial or non-financial risk the committee, the bank really needs to take, any company really needs to take, which will approve the risk appetite every year. And based on whatever the historical performance is, it will try to set and approve the risk limits for the bank or any organization for that matter. So this committee is more responsible for establishing, documenting, enforcing all the policies which are involving the risk. Wherever required, some specific business level risks are being reported to the CRO. So this is an important role that has come out as under the guidance of the risk advisory director. And CRO wise, on a regular basis, he is the kind of point of contact who will inform the board and the senior management about the appetite for risk. Whatever the views of the board are there, he is responsible to make sure that they are being communicated to the entire organization as far as risk management is concerned. He is responsible for monitoring the limits throughout the year. If at all there is an exceeding of the limits, he has the kind of right or authority to order the business units to reduce their positions or close their positions, and some of the responsibilities he can very well delegate to the heads of various business units. So that is where the CRO is acting as the bridge between the regular line departments, the risk management departments of the individual business units, and the board. That is where there is some level of integration that is coming up between the corporate governance practices and the risk management practices of the firm. So even if we see the overall delegation process, if you look at further one example of market risk, the risk committee, which is a part of the board, that is approving the market risk tolerance. So the limits, the market risk should be between this and this. That is what is being approved. And there is a delegation of the risk from the board risk committee to the senior risk committee within the organization. Now, at the senior risk committee of the organization, what it does, it approves the market risk tolerance, stress, performance limits every year, and reviews the business unit mandates and new business initiatives. So it's coming more towards the operation level. And then delegate the authority to the CRO. So the senior risk committee is delegating the authority to the CRO, and whatever the reserves that are required, it is holding it. CRO is responsible for independent monitoring of the limits. If required, he can order the positions or he can ask the positions to be closed for specific risks. And he can delegate some portion of the risk to the business units. The head of the business unit is sharing the responsibility for the risk of all the trading activities, who in turn delegate the risk to some of the business unit managers. Now what you could see is the risk board-based risk committee is there, senior management risk committee is there, then comes the CRO. CRO is delegating the responsibility to the head of various business units, who in turn are delegating to the responsibility to the different managers of the different business units. That's how the entire flow of information happens. And if you are observing these kind of things in an organization, it is very clearly understood that the company is really serious about the implementation of the risk management plan. And even when I talk about the interdependence, if we simply see from the senior management perspective, the business plans and the targets are approved, right? Whatever is the plan, one relating to the business, these are all business objectives. Then risk tolerance limits are set in line with the business plans and the targets. What kind of profitability the company wants to achieve, what kind of growth and expansion the company is looking at. Based on that, it will arrive at the risk tolerance limits. Based on that, a policy comes up and make sure that the firm is sticking or implementing the policy and sticking to the limits. Once it sets, then it comes to the trading room. So for each kind of risk, the risk exposure is clearly determined. And this room, the trading room, is purely responsible for making sure that the deals, the buy and sell decisions are executed in a timely manner, which are in line with the policy and the tolerance limits. And the official profit and loss statement that gets prepared in the trading room, that is getting signed off. And whatever the next, it passes on to the operations department. Whatever the trades the trading room has really placed, they are booking and settling the trades, reconciling the front and back office positions. The daily P&L is being prepared. Mark to market has been provided independently and support the business needs. And from the information from the operation, the finance team is going to develop the valuation. They make sure that all the decomposed daily P&Ls are integrated and an integrated P&L is being prepared, business planning process and supporting the business needs. And finally, based on this, it comes out that with all these inputs, the risk policy gets developed, and monitoring of the compliance within the limits is coming out, whether on a regular basis the typical trades that are being placed, whether they are within the limits or not. Risk committee process is being understood and evaluated. Whatever the models that are there, spreadsheets that are there, they are all vetted. Independent view on the risk is being provided. That goes as again as a part of the risk reporting to the senior management, who again will take a kind of responsibility in terms of whether some policy needs to be changed or some kind of tolerance limits need to be changed. All those are they in line with the objectives of the business policy and the profitability targets that are being set. This is the entire cycle that goes as a part of the risk management process, right from the senior management to the trading room, to the operations, to the finance, entirely getting together as a part of the reporting process. So when we look at the limits, whatever the process, now board has approved some level of tolerances. Now for each business strategy, the risk management limits have to be really tied up. So for each portfolio of business, each risk type and the overall portfolio, independent limits are getting set. And what should be the number? It varies widely, purely based on the activities of the bank, the size of the bank, the sophistication of the activities. All these things really take shape. But whatever the limits that are set, they really need to be consistent so that the comparability becomes more and more easier. And here also there are two types of limits. One we generally call as tier 1 limit, which is more like a single overall limit for each asset class. And the stress test limit, cumulative loss from the limit for each of the asset classes. But when we are looking at tier 2, it is more and more general, authorized business and the concentration limits that are there in which area, in which particular type. At a broader level, this is more for each asset class, whereas this is over the entire position, which is targeting more in terms of concentration limits, seeing whether the limits are in line with the authorized businesses or not. So for each there is a risk limit, and whatever the limit that is being set, that is consolidated to risk across the various businesses and activities. And when we are having a common language for risk, sometimes this entire limit being set, let's say in terms of economic capital or in terms of value at risk, which is a kind of a common language of risk, limits can be made fungible across the different business lines. So the limit setting is one of the key processes which really needs to be well understood and well appreciated. And when we are looking at the standards for monitoring different kinds of risks, it comes right from valuation of each of the positions. Should they be done on a daily basis or not? What is the kind of strategy for valuing? Should it be mark to market? What are the assumptions that the company has used in terms of trading here? Frequency of preparation of the P&L statement, business unit wise as well as the entity wise. Whether the reports that are getting generated are timely and meaningful, and at the same time are they in compliance with the risk policies and the limits. What to do in case any kind of exceptions are going to come out. If any trade is exceeding the limit, what is the kind of escalation procedure? setting up that procedure if required, what is the kind of deviation that is coming out between the predicted model and the actuals with respect to the volatility, and the major things, what kind of data is really being used. Make sure that the data that is used in setting, in evaluating the limits, it is purely independent of the front office. Don't ask the front office guys to supply the report to you. That is where majority of the accounting scandals have really come out. So there should be a proper system in place which supplies the data. It should be reconciled with the official books of the bank, not just picked up from the trading database. After the reconciliation with the official books of the bank, that specific data needs to be taken. So, which means the data should typically be derived from the consolidated data feeds, not a standalone stuff, and in a data format that allows the risk to be properly measured. So, as far as the escalation procedure is concerned, before the excess is coming up, there is an advice to the risk management team, and once the excess has occurred, on a daily exception report that comes out, the exception reports could be of type A or type B. So some reserves, for the type A excess, probably a little bit of reserve of around 10% can very well be used, and there could be a kind of information to the senior risk committee that there has been an excess. Whereas when there is a type B excess, there could be a direct approval or it could be escalated. So each business unit risk manager, or there could be, or even at a CRO level, the CRO can really approve these type B kind of excesses, whereas they have to be referred to the senior risk committee in case of type A kind of excesses. Coming to the audit function, the main role is do a periodic investigation. Make sure independently that the design and the implementation of the risk management in the company is more and more adequate. The documentation is sufficient enough. The processes are efficient. The risk management process, the system is completely integrated. The risk control unit is performing a proper functioning. Risk measures are more and more appropriate to the business, and they are integrated into the daily risk management procedure. All these things need to be taken care and need to be ensured by the board. And any kind of pricing models the company has developed, this particular function is more responsible for vetting them. Every valuation system that is used by the front office personnel, back office personnel, all of them really need to be vetted for the correctness and model errors. They should be doing some kind of back testing on that particular data, on that particular models to really verify whether they are accurate or not. Any kind of significant changes coming up in the measurement process, if the computation mechanism got changed, any process that got changed, validate it, see whether it is fitting into the big picture of the organization growth and development. The MIS, just evaluate what is the integrity of the MIS, what is the kind of data that it is giving, is it independent, is it biased, accurate, completeness of different kinds of positions, what is the design and the conceptual soundness of the various risk measures that the company is taking, and any kind of calculations or frameworks, just evaluate the reliability of them. That is what uh, forms one of the key roles of the audit function in a particular organization. Now, all these things tied up, integrated together, is what will create effective corporate governance practices integrated into the risk management. And that's where the risk management practices that are implemented by the firm will be in line with the expectations of the various stakeholders. Right?